Hello, everyone. Welcome to Leaders Give Back, the Engage FI podcast where experience meets the future of financial services. As we step into 2026, the financial services industry faces a year of really big questions. There's the economy, interest rates, earnings pressure, the hunt for growth, technology innovation, and shifting demographics. All of these challenges happening at the same time. And to talk about all of this, I'm joined today by three powerhouse leaders, each of them with more than 40 years of CEO experience and management experience. They're now serving as Engage FI executive affiliates. You'll hear from John Cassidy, the former CEO of Sierra Central Credit Union in California, Kathy Pace, the former president and CEO of a legacy federal credit union in North Carolina, and Gene Pelham, former president and CEO of Rogue Credit Union in Oregon. They're going to share hard-earned lessons from 2025 and fresh perspectives informed by 2026's defining forces. The largest generational wealth transfer in history. We have to talk about it. The rise of Gen Z and Alpha in leadership, and the mainstream adoption of agentic AI and generative AI. They'll offer guidance for leaders navigating change and also for leaders looking for ways to grow through scale, through new income pathways, or both. This is the 2026 Outlook, challenges, opportunities, and the leadership it will take to thrive. Let's dive right in. Welcome back, John, Kathy, and Gene, to the podcast. Thanks for being here.
Hello.
Great to see you, Virginia.
Thank you.
Good to see all of you. I really appreciate you all coming together. I know it's not always easy aligning schedules, but it's an important conversation. You know, as we close out 2025, certainly a great deal has happened in the last 12 months that is relevant to financial services. And as we look into the new year, I would love to start off our discussion just asking each of you, and Kathy, I'm going to lead with you. Go first, please. What's the overall temperature, do you think, of the financial services industry as we begin to transition into the new year? Are financial institutions, are they concerned, cautious, optimistic? What's happening?
Thank you for that question, Virginia. First of all, I think there's probably some of all of those moods out there. But overall, I believe it's best to head into any new year with confidence. But we also have to remain cautious of all the potential risks that are there. I think the new year is one where many credit unions are feeling a bit overwhelmed by what they need to do around AI. I think that's one of the largest conversations and most active that I've heard in a while. Actually, the cost, the talent, and time of AI are definitely top of mind. And just to throw a little humor here, if we agree with People Magazine's Person of the Year choice, the selection of the 7 architects of AI, then it makes sense that financial institutions across the board feel this pressure. But there's a lot more going on other than just AI. I mean, we have midterm elections, we have the issues going on with healthcare, and all these things could affect our members in many ways. So this is helping to create the mood as I think we begin this new year. And I personally think that leaders, which is what I did as an active CEO, take a deep dive into the areas of the previous year and assess where your greatest opportunities created the greatest impact to the membership. And whatever those areas are, just keep doing more of what you did best. But most importantly, understand how and why you had those successes. But here's the bigger challenge to that. We have to make intentional trade-offs. We have to decide what to stop, what to double down on, and last of all, where to accept good enough, because we all struggle in these areas.
I like that, focus on what you do best. John, what are your thoughts?
Well, I think there's, to just add to what Kathy had to say, there's so much going on right now in the economy. It's it's both interesting, exciting, and a little bit scary for folks. You know, people have just come and gotten their budgets approved now in the last month or so, and so they're looking forward to 2026. And, you know, again, I believe that 2026 is going to offer the greatest array of opportunities that we've seen in the marketplace in a very, very long time. I think the market itself for financial services is going to allow any institution that's willing to really get after it to help their members, their customers more than they ever have. There's going to be great opportunities for real estate. That's been pent up for quite a while. Most people think there'll be at least a couple of rate cuts next year, and rates will help that equation. But I think people's incomes people are going to see income increases. The real income is going to go up. You see the tax policies are going to take place. And I think credit unions and community banks that are aggressive in their communities regenerate those relationships, build upon the relationships that they currently have. And as Kathy said, do what you're doing well, double down on those things. And I do think that the biggest opportunity is the decisions along the lines of what you're going to do with AI and what you're going to do overall with technology, which is the reason we're all here, and the three of us in particular that are here to support Engage FI's opportunities in the marketplace and what they bring to the table, because making decisions going forward in the economic climate we're going to have next year are going to pay huge dividends, not only next year, but in the years ahead. So I think the opportunities are endless next year, and I think there's a lot of more excitement than there is trepidation in the financial services world as we move into 2026.
Yeah, I agree with you, John. I mean, I think one of the key messages going into the new year is you have to align your technology strategy with your financial strategy. And I think a lot of institutions are still struggling to do that. Gene, do you have anything to add to sort of the temperature?
Well, hang on. I'm still finishing up all my notes from all that Kathy and John said. Incredible insights. I'm not sure I can add much to that other than what I'm experiencing in the small credit unions that I'm helping is just this kind of overwhelmed perspective as there is so much to do and not enough people to do it. And I think Kathy had an incredible piece of advice: is understand what you can do good enough, and focus on the most important thing. And I still think the most important thing is being our true, authentic self as a credit union, as a member-owned financial institution. Understand why we're there, which is to make their lives better. And no matter what challenges we face in the coming year, if we fully live up to that, then like John said, anything that's in front of us we can accomplish and we can win at too. So I'll leave it at that.
Gene, can I just continue? There's economic challenges, of course, margin pressure. Those things are all top of mind for a CEO. How do you expect those forces to evolve in 26? And specifically, I'd love to get at what financial institutions can be doing to prepare. Yeah. Is there still time to prepare for 2026?
Yeah. Well, if you haven't been preparing to have a resilient balance sheet for the last several years, you don't have enough time for 2026. I see both John and Kathy shaking their head like that. So I think more than anything, the preparation is going back to understanding who you are as an organization, how you've built your balance sheets, and how to move with the opportunities that are presented with you that allow you to continue to be the authentic credit union that you are. One of the things I see a lot, and I've seen more, is this increasing pressure on return. Looking at ROA, our ROAs have been down for quite some time, and trying to maximize ROA. And I was talking with someone about this, and we have to make sure that we don't confuse profit with the destination. Profit is the fuel. Profit's the fuel that drives us to go forward. The destination is our purpose and delivering on that member ownership value promise as we go forward. So I guess getting back to your question, how do you prepare? You should have been doing it all along, building a balance sheet that is resilient either in an up economy or a down economy, and then being prepared to take advantage to whatever is the opportunities that are given to you as you move forward. And remember always that profit is the fuel to do more, not the purpose of their destination to get you there.
Love that.
Kathy, John, anything to add there?
Well, I would just say that, I mean, to build on what Gene said, I mean, if you're not prepared at this point, you better get the candles lit and you better get prepared. And having quality balance sheet management within your management team and everything you're trying to accomplish is critical to your success. But that's not your mission. That's a result of your mission, is to make sure that you're in a position to help your members and you build your balance sheet so during any type of economic climate, whether rates are rising or falling, that you're able to make adjustments as you need to meet those needs of your customers and your members.
I just want to add a quote, if I could, Virginia, to reinforce what you said, Gene. The author was unknown, but the quote is, "The goal is not the goal itself. It's the process all along. That's your goal." Mm-hmm. Meeting those milestones.
Mm-hmm.
Yeah.
And that's something that you continue year after year and get better and better, and momentum builds and builds. Speaking of momentum, it feels to me like after years and years of concern around fintechs and just wondering how are we ever going to compete, it just feels to me like traditional financial institutions are starting to come back into their own. It's starting to feel to me like members and customers are recognizing the value of a financial institution where they can really house the majority of their relationships, because who wants to have 25 apps on their phone? It feels like we're getting away from that. But then still the deposit competition is just so extraordinarily fierce. It feels like, commoditized financial services in some way, and no institution wants to be relegated to that position of being the holder of deposit accounts. But talk to me a little bit, Kathy, I want to start with you.
Okay.
What new factors or players do you think will influence deposit strategy in 2026? Is this still going to be as intense as it has been in the last few years?
I think in my lifetime in a financial services, deposits there's always been a race for the deposits, no matter what. I do believe that competition race is going to continue. There's always going to be profitability measures like Gene talked about earlier, and even with the most recent cuts, many of the credit unions are going to still be operating with tight margins and without more real rapid changes like we did get to see in the past. That's going to continue. To me, the deposit space is a very hard area to manage, no doubt, because deposit costs will be elevated even as these rates stable off or level off a little bit, and the competition is just going to force this. I think the more that we see new charters, which I've just been reading about this week, of being approved, that hurts us even more, and it raises our level of blood pressure as to, okay, another competitor is coming along the way. But even in addition to that, I think the whole deposit landscape and what's going on is also going to have an effect on our loan growth, because we're going to have to be more competitive and we're going to have to be more sensitive on the risk side. And then you add all of this to watching our operating expense as it continues to rise every year, particularly around comp and IT. So when we think about this, I think you may have asked, so how does outreach maybe play a part in all of this? And I believe it was really critical to understand, and I mean really understand, who your top depositors are as well as your top creditors, because the member wants attention. And I think it's highly expected now more than it ever was. And I will tell you, being out in the marketplace more and doing a little bit more of my own personal shopping, I get that. I want that attention. I want that financial institution not just to know my name. I want them to know who Kathy Pace is, what my needs are. So I think service is going to matter more than ever. And if it isn't there and that member doesn't feel appreciated, we already know they will leave as little as with a 5% point drop or whatever. And here's the other thing I would say as it relates to outreach. It is not hard. It is actually simple and it's highly impactful. And what can outreach conversations do? They can reinforce the confidence of the organization, that it can help demonstrate the credit union's overall commitment. And last, and which I think is the most important, and certainly, is it can retain and grow relationships. And we all want that entire family as an opportunity to protect future generational wealth. And another data point, the latest U.S. projection that we talked about with this wealth transfer for the U.S. projection is 124 trillion with a T. We need a part of that. Just a small percentage of that would take us over the top.
And so
Those are my
what
thoughts.
I'm hearing you say, Kathy, then is when you're competing for the deposits, it's not as simple as competing on the rate, because that's a really difficult game to play. You got to really compete in the experience.
Absolutely.
John, I know you've got some thoughts on this.
Yeah, Virginia, that was you couched that very well. It is about the relationship, and you want to reward your best customers, your best members, in a way that they feel like they want to stay with you. You're building credibility and stability all the time with those relationships. And if you reach out across all platforms, whether it's in person, whether it's electronically, whenever those touch points occur with those customers and members, you want to make sure they feel like, as Kathy said, that they're getting something of value there. They're just not an account number. They're not somebody that people just move off of and go to the next client. You need to make them feel special in different ways. And there's always been a rate game in financial services. We've all been in the business 40 plus years. If you're chasing rate as an institution, you're just not going to be around, because there's not enough of those people that are ever going to be loyal enough to you for you to build a foundation and a balance sheet that you can rely on when you have to make moves to help the majority of your clients. That's not a good business model, is to just chase rate all the time. With that said, we're all adults here. You have to treat your best customers in a way where they feel appreciated, or they will leave. The rate shoppers, they're going to come and go. That's just always been 15 or 20% of the business you really don't control. But as we go forward in next year's economy especially, I think the ability to generate those relationships, and Kathy touched on it, the greatest wealth transfer in the history of the world is going to occur in our lifetimes here. And we better be ready in building those relationships, not only with the current members and customers we have, but their family members going forward, because you want to retain those relationships and you want to grow those relationships over time.
One thing that just came up for me is that a lot of the smaller institutions in particular they may recognize what we're saying here, that don't compete on rate, compete on the relationship. But if you look at their environment, their technology environment, their operations, they're really set up to compete on rate and not on the relationship. So something's got to shift there. And one of the ways to get access to the kind of innovation that they need is to merge, right? To get bigger, to pursue scale. And so, Jean, I wanted to get your perspective, because I know you've got a lot of experience. We're seeing growing M&A activity. Part of that is because of, regulatory pressure around M&A not being quite as intense, but a great deal of it is because of need, because of necessity. We see credit unions buying credit unions buying banks, much to the irritation of our banking friends. And we also see these new mergers of equals. We see some really big financial institutions coming together. John, I know you've worked in that environment as well. So given this, what trends do you expect to see in 2026, Jean? Do you think we're going to see more mergers? Is there going to be any reshaping of financial services as a result of this? Because this is another form of competition, right?
Yeah, very much so. And I do believe that mergers and acquisitions and even purchases of community financial institutions will continue to be a key strategy issue. But key word there is strategy. It's often I've heard this being said is that well, my asset size is this, so let's put the vanity aside and look at the real strategy that we can accomplish through a merger and acquisition. And does that merger and acquisition give us a better technology stack? Does it give us access to services like business lending that we currently don't have access to? Does it give us access to a younger membership base? I know one of the things that we'll talk a little bit later is about the changing demographics of credit unions, but oftentimes we're merging in credit unions that we're just adding a more mature membership base than the one that we already have. So making sure that you are really choosing a strategic path through this merger to give your organization, your members, better resources, better tools, and a greater opportunity for success going forward. And I think that's what we're going to see. I think we're going to see. I'm not saying that past mergers haven't been smart, but they've been opportunistic. And now I think we're going to be more strategic in the way that we seek out merger partners and looking at the capabilities and abilities that we can add as an organization.
And Jean, we've talked about this before, and something that has struck me about the way you look at competition, especially the smaller financial institutions. You said something very interesting. Remember who you are. Can you elaborate on that? Because I find that so powerful.
Well, we're in a financial services. It's very commoditized. There are some unique products, services, capabilities that are out there, but for the most part, the differentiation between each other and the products is very, very limited. But we do have the ability to be more intimate with our membership, going back to what Kathy said earlier about knowing your members and understanding them. We've got some really great opportunities through artificial intelligence and better persona development and all these things to build these understandings about our members. But remember, the line that's at the bottom of every AI item that you seek is, it says, please verify, sometimes we'll provide you invalid information. And what Kathy talked about is putting validity to all this work that's been out there. And sometimes that is boots on the ground, talking to the individual members as we go forward. So I just will say that as we go forward. And I'm sorry, I got so off on what Kathy said because I believed in it that I lost the track of the first question.
No, it's great. I love the way this conversation is developing because, again, I'm hearing incredible messages. What I'm hearing you say, Jean, is, let's remember who we are as credit unions. Knowing the member, that's where we came from. That's how we really grew up in this industry, is being very close to the member, understanding them, treating them, their families, as people as opposed to commodities. And then we grow and compete. And you kind of get away from that a little bit. And now we're coming back to it by virtue of technology. And John, I want to shift to you because I know you have some great thoughts here on AI, automation, digital transformation, all of the personalization opportunities that are out there when it comes to technology strategy. Do you expect the pace of innovation to shift in 2026? Are we going to see a continuation of the pace, or are we going to just take off like a rocket and credit unions and banks will really increase their speed?
I had 2 pairs of new running shoes, Virginia, that were delivered yesterday. And I don't run very fast, but I know I'm going to need them. Yeah, the pace is not slowing down. It's going to speed up. And just touching on the merger aspect of all this, a lot of mergers, as Jean said, were driven by opportunistic scenarios. Strategically now, technology is the major component going forward. because a lot of institutions, and there's been, as you pointed out, Virginia, so well, there's been a lot of large credit unions, like to like, that have merged as well. Well, when you look at some of those mergers on paper and then you talk to the folks that were involved, I mean, a lot of them boil down to the fact that one institution is way ahead of the other from a technology standpoint. And remember, our boards of directors have been around a while. They may not be as in touch with current technology. There's some folks there that are afraid of the AIs of the world. And one of the things I put in my notes here was to make sure is, as you move forward in 26, you need to make sure that everybody associated with your organization, internally especially, all the way to your board members, is getting educated on what AI really means and what it really is going to do. And again, I'll go back and say that, the reason I jumped in with Engage FI as an affiliate was because I know the critical need that exists in the marketplace for good technology decisions, whether they're through mergers or whatever. If you're making decisions based on what needs to be in place going forward so you can compete from a technology standpoint, so you can build, maintain, and grow relationships with your customers and members, technology is where it's at. You better be dealing with experts that have top shelf folks that understand what the technology is that's working today and how fast it's moving forward to move differently tomorrow. And so you can make those decisions that are going to affect your organization going forward, that you can meet the demands of the marketplace and also meet your ROI and ROA expectations. I don't know if I'm really answering your question, but Gene kind of opened that up when he talked about mergers and the opportunities. I just see technology as a huge strategic driver of mergers going forward, both at small and large credit unions. And I still think there's a huge place for small credit unions in the marketplace, and they'll be able to compete at different levels in different ways at times. But everybody's going to have to move forward technology-wise, and you better be talking to experts and working with people that can analyze for real what you have today and what your opportunities are going forward, so those decisions become meaningful and make a difference.
Yep, and that's a very important point. So let's talk about some of those resource constraints. Smaller financial institutions do have resource constraints when it comes to innovation, and I'd like to dig into that a little bit. Kathy, I'm wondering what your perspective is on this. How do smaller financial institutions balance affordability with meaningful innovation? Because those two don't always go hand in glove, right? It's a challenge. We can have great intentions to innovate, and we can have great ideas, but we may not have the talent, we may not have the budget. What to do?
So, as we think about that, this of course has always been a concern for the smaller credit unions, and it's growing, as we just talked about. And now that I've had just a little bit more time to think and read more about the continuing issues facing our credit union, it made me think about a gift that we all have and we're not taking advantage of to a great extent. And credit unions have a distinct gift that few other larger financial institutions share, and that is a deep tradition of collaboration and openly sharing experience, processes, and lessons learned. And I believe that we can overcome some or a lot of our resource constraints together. Other industries are facing the same issue, one that's so relatable to credit unions, if you were to follow them in alignment, is the medical industry. And that the CEOs of the medical industry are having these same types of conversations that we're having as financial institutions. Yeah. And the terminology that those CEOs are using is we have to be radically collaborative. We've got to rely on partners like Engage FI. We've got it, and John has been talking about this just in his last comments. The expertise of some of the things we're trying to create or build, it's just not going to happen fast enough. There's lots of issues that we're going to be confronted with that, and that is capacity fatigue, the lean staffing that we have already, the lack of true expertise, And I can just remember when we thought we were doing pretty good in our data space, and I would request certain reports, and it was a report. It was not an analysis of what it was that I needed to know to make the best decision that was going to benefit and bring additional benefits back. So I think that this is an opportunity for us to think about what does collaboration look like? And it's got to go both sides when you have a partner. You cannot have a partner and be expecting them to call on you and telling you what you could do when they don't know what your business is. They don't know what your strategic focus is. But we do it okay. We do it well. We just do it okay. We don't do it well. So we have to elevate this further for the benefit, I think, of the entire movement, particularly small credit unions. And I don't mean just credit union to credit union, but I also mean credit union partnerships. We have got to have a resurgence on collaboration because we can. But here's what happens. Jean, you said this a little bit earlier, I think. This may mean that top credit union CEOs like we were need to approach this partnership with openness and a lot more humility. Forget about the power that you play, and you got to think about the overall opportunity for the organization. So I think collaboration needs a resurgence.
Gina, I think that Kathy handed you the baton on that one. What are your thoughts?
Well, very much so, and through my work recently, I'm finding a significant willingness by large credit union CEOs to support and collaborate with smaller credit unions. I see a tremendous opportunity. It's one of the things at Rogue that we had was experiential training. And one of those things is let's put somebody that's an aspiring leader in a large credit union to help a small credit union solve their technology issues. Imagine the experience of that boots on the ground, the ability to kind of test and innovate, and then be able to share that incredible expertise with the smaller credit union. That is really, really powerful for those individuals, that experiential, and finding those partners that are willing to do it. What I'm seeing more and more is the collaboration is important because it doesn't make sense oftentimes to merge really small credit unions into larger credit unions. It makes more sense to help them find ways to succeed, and there are credit union partners out there willing to do that, and I've seen it firsthand. And that's what I love about this credit union movement, is when we see people that set aside key staff members that maybe have had experience running a small credit union to help a small credit union out who lost their leader, knowing that person's going to be better for it, and then testing some of their mid-level management to kind of guide and oversee that process. We have this incredible advantage of not only the formal collaborations of multi-credit unions getting together, but these one-on-ones saying, my people need to be better, and here's a great way for them to learn how to do that.
And particularly with the member demographics changing so much, as you were talking, Gene, I was thinking, well, if one credit union gets better, all credit unions get better, because young people will know about the benefit of a credit union. And let's extend this to banks. A community financial institution offers a great deal of value that a young person may not necessarily get from a regional or a large financial institution, whether it is through their value proposition, what they stand for, their sheer size. A lot of young people are showing a willingness to support a community financial institution that's deeply embedded in the places where they live, they work, they go to school. So given that, demographics, it's huge. Generation Z, Generation Alpha, we're on the cusp of the biggest shift in a generation. All of this coming with the great wealth transfer. What trends do you expect to see in 2026, Gene? And how do you think that's going to influence credit union strategy as we move through the year?
I've thought a lot about that question and tried to make sure I was placing myself in the right context, because in the 90s, we were trying to figure out how to attract Gen X as they came along and others. So we've been in this constant battle of trying to understand how to attract the newest, the latest generation. The biggest challenge for us today is where we had years to be able to learn and earn trust and gain credibility with these new generations. Now we have months, maybe even moments. If somebody goes to one of our branches to do business and says, well, we have an appointment 2 weeks from now, and then they go out to their car and within let's say 5 to 10 minutes, they've opened an account at Chime.
Yeah.
Boom, we've lost that. And so we have to understand is that while the imperative hasn't changed, the velocity of it has changed significantly going forward. So what are we doing?
Absolutely.
Yeah, what are we doing to make sure that we're ready to understand that velocity? I think each of these places, Chime, SoFi, they present unique challenges for us, but I also believe they present unique opportunities for us as we go forward in understanding that in many ways, they're like a dating app. We're seeing, I think I saw a number, 13% of all new checking accounts are being opened at Chime right now. But that's the date, that's the fun part. But what we're also seeing is that when members start to think about, financing their first home or some other major purchase, those places don't deliver as well because they're not as personal, they're not as empathetic. And so we need to understand the opportunities that are there and available for us as our generations change in their personal financial needs. So always being there and being ready to help and support them. And then when we do get the opportunity, not dropping the ball. I think that's the other part, is being there, taking advantage and doing it, because we don't have much time and there are too many opportunities out there, but we will win if we show them that they can trust us, that we're purpose driven, and that we're there for the long haul with them.
Yes, and it gets me back to AI, strangely, right? We're talking about people and human emotion and need, but think about the digital transformation, right? Credit unions do a great job with that intimacy with members. Then digital comes along and all this distance gets created between the member and the credit union because we're taking everybody online, removing ourselves from that personal relationship. And now with AI, we're bringing it back in. We're demonstrating we know you, we see you, we understand your need, we care about you, but we're doing it in a way that resonates with younger people. And I think that that's really a massive change that we are going to see as we move through 2026, is this idea that we do have an opportunity now, ironically, through technology, to bring the member closer to us again. Mm-hmm. And I love that about our industry. John, any thoughts? I see you nodding.
Yeah, well, I mean, Gene used the term velocity, and I'll add pace to that. But to the big deal, 8-9 years ago was, okay, we're connecting with the young people on social media, Facebook, all these social media apps. It wasn't really about them going out to the car, getting on the phone, and opening an account in 30 seconds with Chime or whatever platform they're trying to open on. Our opportunities, we have to deliver that type of technological connection for those younger members. That goes without saying, because the numbers speak for themselves. You made a point earlier, Virginia, in the beginning of this whole conversation about, you think that financial institutions, more traditional ones, are starting to come back to the forefront. The dating app gets a little old because you're seeing the same dates over and over and you're being treated the same way. There's really not a relationship there electronically. When people need meaningful financial services, i.e. their home loan, their car loan, their small business loan, they're going to want to talk to somebody face to face. I think that will always be the key element in why people do meaningful business. They don't want to be standing in a store with 50 people in line while people are bagging their groceries in front of them and doing their banking. I think that things have shifted back to a more normal state, with people looking at financial institutions, some of the brick and mortar, as well as the technology aspect, making those decisions that are going to allow you to connect electronically with the next generation and future generations. That has to be one of your main, if not the strategic goal, is how do we stay connected to those people? How do we make sure that we're connected with their parents in a traditional way, but we're also getting that first checking account? And I can tell you, I had a member come up to me a couple weeks ago who told me a story about his son who went to do exactly what Gene said, went in the bank, they were going to put a 30-day hold on his checking, and he went back over to the credit union, they put it right in and no problem. Those situations are still real. So I think the technology part of this equation is so important to get right going forward.
And you said something that really stands out for me, John. You said that you're going to want to connect with their parents in the traditional way and with this new generation in a completely different way. And that adds to the complexity of the technology environment when you do need to support those different engagement models. And they're going to be essential going forward. The other thing that came up for me is you were talking, John, is this whole notion of traditional financial institutions coming back to the forefront and people wanting that face-to-face interaction. I think it's particularly true of Generation Z. The data shows that not millennials, the millennials are the digital distance generation, right? But the younger people, Generation Z and Alpha, they want eyeball to eyeball. They'll talk to you on FaceTime. They want advice. They need to feel like their money is safe. They do a lot of research. Security is important to them. And so as a result, I see a terrific opportunity in 2026 for credit unions, for banks of every size to be really successful if they play their strategy cards right.
Correct. Yes.
Virginia, could I add to this conversation about AI? And this key question is, are we going to be using AI to improve member outcome or just to automate tasks? And are we going to be careful just because every application we have, you can throw AI into it? Is that going to spread the peanut butter of AI across the board? But is it really going to be beneficial? So shouldn't we, as credit unions independently, look at what our niche is? Every credit union has a different niche. And if you could concentrate on what that is and what your successes are, and that's where your focus on AI is, and if you don't have the right technology for that particular niche, then that's when you go to that external partner. I mean, if I was in the active world today, that's what I would be looking at, making sure that what we do so well has the best AI attached to it, and not worry about that AI's got to be integrated in every single thing that I do.
The alignment of technology strategy with financial strategy. I love it.
Very well said. Very
And
well said.
they're so interconnected. So let's shift to sort of closing out our conversation. I'm always interested in perspectives on blind spots, right? So if you look, Kathy, I'll stay with you. What is the biggest blind spot that you see in how financial institutions are preparing for 2026? You can't
I think I just answered that. When I thought about this question, that's the one thing that's been on my mind, because some of my former colleagues that I've been talking to, they're so excited about AI. And this is exactly what they said to me. They said that, you know what, we can integrate AI into every application that we have. You may not get all the right answers that you need for that. And we know that, yes, and we know that we've already said that, our members are going to expect us to know everything because they know AI exists. But I also think we need to be very careful and ensure against the future AI fallout. We know it's going to happen probably. But the worst thing would be if we're not planning for it. Mm-hmm. And who clearly owns your AI? Where's the governance of AI? All of those things has got to be put into a formalized plan. And that might be a little blind spot right now because we're so excited about the shiny new tools, and we all love those, that we might be forgetting about some of and I'm a real big governance I'm gonna say guru. It's a thing because I'm a rule follower, and I think this is one that could come back and bite us if we don't have the right plans and process. That's what I've been thinking about from a blind spots standpoint.
Mm-hmm. Jean?
So, kind of following up on AI, I think one of the biggest blind spots that I see, and we have a very good opportunity to overcome that, is to realize that AI is not the ends; it's the means.
Yeah.
It is the means to being a better credit union. It's a means to be a more member-focused credit union. It is the means to do all the things that we always wanted to do, but didn't have enough time or people to do. And so let's remember that as we look at AI and leveraging AI to the members' benefit in everything we do. I think that is really important. And another blind spot too, and we were talking a little bit about younger generations and so on, is understanding that for those of us that have branch networks, we have a tremendous resource, especially with younger members that maybe weren't able to get their answer, or they're going through those life stages where they want to talk to a real person, is that our branches really are the first urgent care centers for members in many ways, and they need to be set up that way. Our tellers should no longer be tellers. They should be coaches, financial advisors, empathetic listeners for folks that are afraid to ask questions to people because they don't want to sound dumb. And we need to make them feel comfortable enough to come in so that we can build that resilient member relationship long term, because ultimately the way that we treat someone when they're having a difficult time or they need something they're afraid to ask for is the way that will solidify and build that relationship for the rest of their earning life. And so leverage our don't see branches as expenses. I talked to somebody recently and they talked about a student branch and how it was an expense, and I'm going, yeah, but look at how many of those student branch employees are now vice presidents of this organization. So please leverage that. Understand you've got an urgent care center that will build relationships for life.
And John?
Yeah, the one blind spot, I talked about it in my initial comments a little bit. I'll touch on it. I'm going to go a little different. You guys handle the AI thing. I can't do it any more justice than you guys. You killed it. But I think one of the things that I see next year in 2026 is, again, a huge real estate opportunity for financial institutions to really help individuals and families especially. And I think if there is a blind spot, I think making sure identifying and employing technology that fits. In fact, I had this conversation about 2 months ago. Being able to help parents help their children get their first home or upgrade their home, whatever it's going to take technology-wise to make those things happen. Maybe even have to help some credit unions create some new products, but aligning technologies to make that all happen, I think is going to be a tremendous opportunity as the pent-up demand for the real estate market to start really getting going again. I think the big catalyst for that can be first-time home buyers, kids that need to upgrade, but the market might be a little out of reach. How can you align some technologically supported options for parents to help their children in those regards, and really make some inroads in that way? Because they came when I was in the 80s, when I was at Great Western Bank, they created the ARM, the coffee based ARM, and it was because rates were so outrageous, people couldn't afford to buy homes. All of a sudden, this adjustable rate mortgage product showed up, and it was very helpful in the marketplace at that time to get the marketplace of real estate going again. And that's what needs to happen in many financial institutions. The product mix might not quite align with moving that market forward or taking advantage of those opportunities to get people real estate loans where they really need them. So that's one blind spot. And again, I will reiterate, don't let the lack of expertise that you have in-house affect your decisions on technology. Make sure you're talking to Engage FI and the experts to see what you have again, and evaluate going forward what you need to make you achieve your strategic goals.
So that's your advice to financial institutions going into the new year, John?
I think so.
Yeah. Kathy, any advice for CEOs and leaders?
I have two comments. As one former CFO that worked for me once told me, the world doesn't fundamentally change from December 31st at midnight to January 1st. What does change is our perspective, and a new year offers a natural checkpoint, an opportunity to reassess assumptions, refine priorities, and sharpen our focus, and then to make sure that we ensure our teams are aligned with the year ahead. And the second one is my personal mantra. When you are at the peak of your success, which most credit unions are, we've had a really great run. This is when you should be the most paranoid because you can fall faster and harder than when you were trying to get up. So stay paranoid, positively paranoid.
Jean, I don't know how you follow that, but I'm going to ask you to.
Well, it's after living a life of paranoia, and so that was the thing, Kathy, and thank you for touching on that because people thought I worried too much about stuff, but I worried for a reason because it mattered for our members. But I think probably the piece of advice that I would have is trust is earned slowly and spent quickly. And so remember that every action that you take, whether it's on December 31st or January 1st, 2nd, 3rd, or whatever, you're building trust with your membership. And that is your key differentiator as a credit union, purpose-owned a member-owned, purpose-driven financial institution, is that you have the opportunity to build trust as your differentiator. So earn it every day and spend it very, very wisely.
That's a great way to close. I think it's just a wonderfully powerful bit of advice from each of you. And it's what stood out for me. I've taken so many notes. I've learned so much. I've heard some really interesting things. I've heard about the fact that financial institutions, particularly smaller ones, feel overwhelmed. There's a lot to do, a lot of challenges, new technologies. And one of the ways that financial institutions can crack that nut is to become radically collaborative. I thought that was just such a great way of describing it. There was also a comment around boards. The boards need to be more educated. The future of credit union boards, what does that board look like? What kind of technology acumen do they need to have? And then John was talking about, I think so eloquently, the need for new products. And that really stood out for me because we, over the past 25 years, really have shifted product innovation to service innovation through the digital transformation efforts. And so we thought, okay, let's compete on the experience. And now we're coming back to the member. We're coming back to those very specific needs, specific products that are needed in order to really meet the needs of this brand new generation that has some unique options. So that's just a fantastic conversation. John, Kathy, and Jean, thank you. Thank you so much for spending time today and sharing your perspectives.
Thank
you, Virginia.
Yeah.
Fantastic. So, and to our listeners, I hope you leave ready to act. So many great pieces of advice here. There are three things really that you can do right now. You can reevaluate your financial strategy, position yourself or your organization to benefit from these generational shifts that we've talked about, from the historic wealth transfer that's underway. You heard from our executive affiliates on that one. Number two, align your technology strategy with your financial strategy. And now, full stop, now period. Selecting the right technology partners within the right contract structure has never mattered more than now.
Oh, yeah.
Flawless execution is critical. And then experiment with AI, yes, but as Kathy said, just pick what you're really good at and use artificial intelligence to get even better at that. I think that was such sage advice. So maybe start small, but make AI a partner in decision-making and productivity. You're going to be hearing so much more from John, Kathy, and Jean as part of our executive affiliate program. You may see them out in the market at conferences if you have not already. And also right here on this podcast, Leaders Give Back. Until next time, Position yourself for what's next. Have a great rest of your day, and above all, a very successful and healthy 2026. Thank you.